Hi, my name is Michael DeStasio, the founder of Valor Advisors. Valor Advisors helps police officers and firefighters reach their investment, tax, and retirement goals. For today's topic, we're going to go over how should I pay for my child's education? This is a common question I receive from many first responder families because their children are important to them and also because there are just many choices on how you can go about this. So, we're going to dive into the different ways and account structures you can help save for your child's education. The first account structure that we will review are UTMA and UGMA accounts. Here's how that works. First of all, that stands for the Uniform Transfer and Gifts to Minors Act. That's where the acronym comes from. Every state has adopted UGMA laws, but not all have UTMA. The account is a legal trust for the child and all contributions are irrevocable. So what that means is once you put the money in there, there is no getting it back out. The parent or a designated custodian has the authority to manage the investments on behalf of the child. So now let's go over some UTMA and UGMA accounts advantages and disadvantages. First of all, anyone can contribute to the account. It doesn't even matter if you know them or not. They can put money into there for your children. There are also no contribution limits, which is really helpful because you don't have to worry about any rules or did I go over this year, am I under, whatever, right? It just doesn't even matter. There are also unlimited investment options. You can literally put the money into anything you want. And I have a chart at the end that will go through all the different investment types available between all the different account structures I'm going to go through in this video. Funds can be used for any purpose. There are literally no restrictions for what you use the money for later on, or I should say what the children use the money for later on in life. So if they decide to buy like a Ferrari or blow it all on a party or a trip, that's simply what can be done. There's no restrictions. These are available at most financial institutions. It's also why you see this account structure very commonly. Because what most people do is they go down to like their local bank and they'll say, hey, I would really like to open up an account for my children for later on. And they simply open up this account structure for them. It might not be the best for you though, and we'll see why when we go through some of the disadvantages and some of the other ways you can pay for your child's education. The first one is the children gain control of the assets upon reaching majority age, which is state specific. So once they hit that point in their life, they have full authority over the money and they can do whatever they want over it. There's nothing you can do to stop them. This can seem scary because, well, what if my kid grows up to be really bad? Yeah, that's a concern. Obviously, for most people, it's not very likely, but it of course can happen, so keep that in mind. There are no tax deductions to the parent, which is something that you get with some of the other ways you can save for your child's education, so that is something to be mindful of too. There is also no tax deferred growth, which you will also see in some of the other ways to save for your child's education. On top of that, there is tax compliance, and this must be monitored annually. So be prepared for that. Ensure you talk with a qualified tax professional to help you through all those different rules. Next is the Roth IRA for minors. So what this is and how it works is first of all, it's a Roth IRA. You must open the IRA account in the child's name. Okay, so you have to make sure you go to a custodian that allows that. Child must have earned income and file a tax return every single year. So right, they have to have some type of a job or some type of income coming in. You have to report it. That's not such a huge deal though, because the child, you can literally put up to the standard deduction the amount of income for the year, and the child will not pay any tax on that. But now they're allowed to put the money tax free into an IRA. So there are multiple tax benefits for doing this. You're allowed to contribute up to the annual IRA max. So that of course changes every single year. And if your child earns exactly up to the maximum, not only do they earn the money tax free, but now they can put it into the IRA, which can grow tax free too. When the child is in college, they take distributions from the IRA account and it can be used for their educational expenses. Simple as that. Now, one of the strategies that I use is parents can even use their own Roth IRA to fund their child's educational expenses. Most people don't even know this. And if it's something that's good for you, you might want to look into that a little bit because, right, you don't want to jeopardize your own retirement. So definitely speak with a qualified professional to help you make those decisions. An advanced strategy that I like to use is if a parent has a rental property or a business, that can be the source of the child's income. We can get multiple different tax advantages doing it this way. I do recommend working with a professional if you're going to try to enact this strategy, but it's very, very powerful for you and the child. Now, let's look at some of the advantages and disadvantages of the Roth IRA for mine. One of the advantages is that it allows a much wider variety of investment options. Okay. Now, not everything is allowed to be invested in there, and I'll go through that in a few more slides. The biggest advantage is right the tax-free growth and the distributions that are tax-free. Very, very powerful. Any unused funds can be used to give the child a head start on their retirement, which is just a huge bonus. And who wouldn't like that for their child, or if they would have even had that for themselves? Now for some of the disadvantages. The children do gain control of the assets upon reaching age 18. So that is something to keep in mind. It's across the country. Age 18, the money is theirs. Only a child can contribute up to the annual limit, right? So that's why it's important for the child to have some type of income that you report on their tax return so they can then be placed into the IRA account. When you use it for college expenses, you do receive an exemption from the 10% early withdrawal penalty. It is commonly known that if you take money out from IRAs early, there's this 10% penalty. There's a specific exemption for the Roth IRA for minors from that penalty, which is a big bonus. Not every financial institution accommodates opening a minor IRA, and it is part of why you don't see this very often because a lot of people simply just don't know which institutions allow this. So if this is something that you are looking to do, simply reach out. We can get you a list of all the institutions that allow this type of account for your children. For 529 accounts, this is one of the numbered accounts, and you will hear this very often. People will talk about all the time for paying for their children's educational expenses because it does offer a lot of powerful tax advantages and other useful features that you might not even be aware of. So let's dive into some of this. Let's see how it works. First, the parent must open a 529 account for their children, and the child is the beneficiary of the funds later on. This is done at the state level, so most states have their own specific 529 plan, which may offer tax advantages in that state. You can choose to use any state's 529 plan. So if you decide to use the state north of you, south of you, east or west, it's totally your choice. There are no limits. But keep in mind, if you do that, you might be sacrificing the tax advantages in your state and anything else that they have to go along with it. So before making those decisions, make sure to research what is specific to your state and the 529 plan. Contribution limits are set by each state and also follow the IRS gift tax rules, which do change every single year. So you want to be mindful of that for how much you can put into the account each year. If you want additional information on these tax topics, please visit this IRS link below. Now for some of the advantages. For the first one, this can be used for high school or trade school. A lot of people do not even know that 529 accounts can be used for the children's high school education. A lot of people do want to send their kids to a private high school, but think, well, I won't be able to afford it. It's a lot of money. Well, now you can set the money aside in the 529 account. It can grow and it can give you that leg up so that you have enough money set aside later on to pay for those costs. Also, unused funds can be transferred to another family member or rolled over to an IRA up to $35,000. That is a huge bonus because a lot of people are always concerned about what if my child doesn't go to school or something happens, they get a scholarship. Well, if you have other children, they can use the money. You can use the money for, you can roll over the money to an IRA. You can roll the money over to yourself and you can go to school. There are literally tons of options. People worry about that a little too much, in my opinion. You only have like a less than 10% chance of not using the money for your child's educational goals. So don't even worry about that too much. There are plenty of ways for you to use the money for yourself, other children, or even giving them a leg up on their own retirement goals. The 529 account does offer tax-free growth and distributions, which is huge. It allows you to have more money later on to pay for all these expenses. And as I mentioned before, there are state tax deductions available to those who contribute, and it of course depends on your specific state. One of the things that I really love is that it allows you to front load 5 years worth of contributions into 1 year. So this is a really great strategy for grandparents who want to give their grandchildren some money for their educational goals later on in life. Following the IRS gift tax rules, they can choose to front load all 5 years worth of contributions in year one. That just allows the money to compound much longer over time and allows you to have even more, potentially even more money to pay for the expenses later on. Now for some of the disadvantages. There are limited investment choices associated with 529 accounts. These are all plan specific. They may or may not meet your needs, but for the most part, you should be able to find something that works, but just keep that in mind. The money can only be used for qualified educational expenses set by IRS guidelines. Now, this might sound really scary at first, but it's not. Things like room and board, books, tuition. You can use the money for things like the internet. There's a lot of stuff in there that qualifies. So don't be too scared by that because remember, more likely than not, you're going to use all the money up for tuition and everything else. So I was talking about before the different investment options that you have with all the different account types. So here on the left, we have the different investment types, right? Cash, stock, bonds, insurance contracts, right? Which are things like whole life insurance, annuities, even real estate or other assets. And here on the top, we have the account structures and what you can invest into each of the account types. So as you see, they all offer the ability to invest in cash. So if you want to do things like certificate of deposits, that's available and earning a cash rate of return. Of course, stocks, bonds allowed in all of these. Of course, things like mutual funds and ETFs are usually allowed in all these different account types too. As for insurance contracts, there may be specific limits for the IRAs. 529 accounts do not allow any type of insurance contract in there. And then you might want to check with your custodian on the availability of real estate assets or any other assets that you might want to invest in, like precious metals or commodities. Definitely check out the IRS publications or with your custodian to see if they support those specific investment options. Now for a summary. When deciding which education account to choose, start by identifying your goals and your needs. With proper planning, you will create an actionable plan to help your children. If you'd like help with anything I talked about today or to start investing for your child's educational goals, reach out by visiting valoradvisors.com or send me an email directly, michael@valoradvisors.com.
I hope you found this information helpful and informative, and don't forget to subscribe to our channel and like the video to help us reach even more first responders. Thanks.